In this video, traders, we're going to explore the difference between a stop price, a fixed stop price level, and a stop zone. How do we deal with the difference between the two and the pros and cons of using one versus the other? Stick around. Hey guys, warm welcome to you. Thank you for joining me. Yes, again, appreciate your likes, shares, subscription, all that other good stuff. Hope you are doing well in your trading. Hope things are progressing for you. Hope you're moving forward. And I hope the videos are helping you in some small way. I don't pretend to know everything, guys, whatsoever. I don't have all the answers. But hey, if I can share something that resonates with you and helps you just a little bit in your trading, then that's great. Let's get onto it. So stop price versus stop zones. All right, so a stop price, probably not the correct way of putting it, but I think you'll get the idea, is when we have a fixed level. So we say to ourselves, right, I am going to come out of the trade if it hits, I've got the SPY up in front of me now, 420, for example, 420. That's my stop level. So basically, if you're long and price gets to 420, you're out the trade. It's just very simple. It's just a binary event. Price touches it, fine. Now, the other way of looking at it is a stop zone. So a stop zone is really a level where you're going to reassess that trade. Now, you might say, okay, between 420 and 419, I'm going to reassess my trade. So what does that actually mean? It basically means that if price is getting to that level, you're not just going to automatically close the deal. You're not just going to take your loss. You're going to assess it and you're going to make a considered and independent judgment. You're not going to be swayed by emotion or any of these type of things. And this is why I'd recommend that don't use stop zone. The stop zone strategy if you're struggling with discipline, or if you're trying to still nail your discipline down, you're breaking rules and stuff like that, because it just can cause you all sorts of problems. But if you're kind of over that, you feel like you're sticking to your rules well and things are working for you, then it's something to consider, because the advantage of using a stop zone, if you trust yourself, that is that it allows you to objectively assess the situation as it stands and make a new plan, short-term plan for the trade, rather than just saying it's hit my level, I'm out. Because if we think about the whole price action ethos, understanding why price is doing something, why it's getting there, what's happening. And very often price can move to a level and there's numerous different permutations of the way that price gets to that level. And so for us to treat it as a binary event, it's just hit the level, I'm out, sometimes isn't the right thing to do. I'm not saying that this is definitely the wrong thing to do, but sometimes, and the right conditions is absolutely right, but sometimes we just need to reassess. Now, the downside, of course, is that we don't have full control over the amount we lose. There is potentially going to be more loss than you bargained for. So if things are very, very tight, this is not suitable. However, if you're prepared, it's the same with everything in trading, guys. It's giving with one hand, taking with the other. You're prepared to risk more, or a little bit more of an unknown amount. So let's say you're risking let's say you're risking $200 on the trade. $200 on the trade, plus or minus $50, say. If you're prepared to do that, then you can implement this. If you're not prepared to do that, then you can't. So what do? The idea is that as price starts to come to a level that you've predefined, you review it and you decide what's going on. I'll show you a trade that I took in a moment. It's actually a losing trade, complete stop out, but I'll show you how I managed it and got out a little bit of a better price. But this is what I've got in front of you now, which is SPY, S&P 500 ETF. And it's a great example because yesterday was a perfect example of this type of scenario. Let's say you were going long around this kind of level here. Let's say you thought, what's flush lower, I think we're going to rotate back. It's about midday Eastern time. This is the kind of thing will happen. And I'm going to have a stop level under here, or stop zone, should I say, under the prior day's low. So this is you saying, okay, you could have a fixed stop under there, and that's quite valid, but you might say, what, we have a propensity at the moment with the situation we're in the market to kind of test lows and hold. So I just want to review it. I want to see what's happened. And you go into that level, your alarm goes off, your trigger goes off, you then analyze it. You say, okay, what time is it? What's the movement? All this type of stuff. You might then surmise the volume's not much. The time of day is generally when we have intraday reversals on the US indices. I'm going to wait and see. It's a 5-minute chart here, by the way. I'm going to wait and see. Let me just see what happens. Let me give it another 5 minutes. Now, What's the worst that can happen in 5 minutes? Well, the answer to that is could fall through the floor. But under normal conditions, this is what we're trading now. Normal conditions, even if you've got another rig red 5-minute candle, the loss isn't going to double to what you were. Depending on where you took the trade, of course, but it's not going to be massive. And if you're there watching it, you can still stop yourself out any time. The point is, if you think that this is the way that price has got to this point, the time of day and all of the stuff that you take into account when you're taking your deal, that this potentially has got a chance to reverse, then why would you come out of the stop? Again, got to be part of your plan. We're not breaking rules here. You review it and you say, I'm prepared to give more here. My plan was a stop zone. I'm prepared to let this thing move a little bit more because I think we might roll back. We might come back. Now, in this case example, it did. It did come back. If it had gone straight through, you'd have lost more than you set out to lose, but you've given it a chance. It might even get to that level. Let's say it got to that well early. Like it's a little bit early. The volume's increasing. I just don't like it. I'll come out. So you can still come out, but you're giving yourself that decision to make. Now, if you don't want to have any extra decisions to make on the fly, I understand why you wouldn't use this. It's just something else to potentially consider. So let me show you this trade that I was in the other day. Now, I was in this trade, Roblox, it was a stock, and I'd bought it kind of lifting up, thinking, you know what, on a daily chart, it looks like we're going to kind of maybe push back to highs. We'd found a bit of support here. This is a 5-minute chart, and I thought, yeah, you know what, it was a good intraday entry, closed reasonably at highs, not quite from the highs of the day. I thought, you know, I'll hold it overnight. Now, unfortunately, it gapped lower on me. Not devastating. I obviously don't like to take this type of loss, but it happens from time to time. And guys, this is trading, real world trading. These things happen. They shouldn't be there. It shouldn't be in big enough size that it wipes you out. You should be able to recover from it for the few trades, but you know, you take the rough with the smooth. I've plenty of trades that have gapped up in my favor. So you know, it's the way it is sometimes when you're trading stuff that have overnight gap risk. Anyway, the point is, as it gapped lower, I was watching this thing, and very often we have this pattern. And this is where it comes in with understanding the price action and trade of the vehicle that you're involved in. And very often we have on stocks that flush lower 5, 10, 15 minutes worth of move that then finds a bid and pushes back up. So as we gap lower, my initial thing is thinking, these are my options. Do I dump it? Do I leave it? Do I add to it? And at the end of the day, I said to myself, right, do you know what I'm going to do? I will cut some of the position. I don't want to be in most of it, so I cut some of the position. I just thought, you know what, let's just trim some of the risk. It was, you know, I didn't want to take the loss. I didn't want, that's not the right way of saying it. I'm happy to take the loss, but I didn't feel like I needed to just jump out of it and panic out of the trade. Yes, I wanted to close this trade because the thesis was wrong, but how can I get a best possible exit and take the least worst loss, that makes sense, that I can? So trim the position. Let's just calm things down a bit. Let's just trim the position, take some of it. So straight away, trim the position as soon as the open. Fine. Starts to move lower. I'm saying, okay, well, let me see what happens at the first sign of a bottom. First sign of a bottom was here. Starts a little retest on the 1 minute and then starts to find a bid. Now I can say to myself, all right, if it now, and it was $80 as well, so it was around a kind of key level, and it was around the time I see reversals normally. So I can say to myself, you know what, let's see what happens. Let's see exactly what the price wants to do. You know, I'm prepared to now risk maybe under 79 and see what happens. And in this scenario, it worked out okay. Apart from the one obviously I closed, it worked out okay. It pushed up, and I ended up putting a stop under below that flag, and I got stopped out here. So yes, a heavy, reasonably heavy loss on the overall trade because I was in from the day before, but much better. A kind of $4, whatever it was, improvement. Well, actually, I suppose if I closed it right at the open, it was 83. So slightly better than just dumping at the open. Way better than just kind of vomiting out the kind of flush lower. But the point is, guys, is that, you know, you sometimes it's okay if you are comfortable doing this to sometimes say to yourself, right, where is my zone? Where is my stop zone? How am I going to deal with this? How am I going to come out of this trade in a better manner? This is slightly different to maybe the first example because that was a fixed idea and you review it. But this is very similar to maybe something you take. So let's say you took it here and your stop was at $80 anyway. Just imagine that for a second. Your zone was there. Now you either come out $80 and it's fixed, or you reassess and you look at time of day, look at how it's got there, look at all the other things. You say, I'm prepared to give back a little bit more because things are lining up potentially for a bounce. If it had carried on going lower, I'd have taken more of a loss than I wanted to, but I was prepared to accept that for the chance of getting out at a slightly better price and lessening the damage. So two different scenarios there, but the point is, guys, is to think about if it's something suitable for you, if it's something that you can objectively assess and go, hey, you know what, that's okay, that I'm prepared to hold that, give a little bit more because I think there's a chance of that bouncing, and you're looking at it objectively. Or you say, you know what, that's devastating, I don't like that one bit, it's right at the level I said I was going to come out at, I'm coming out anyway, and making that decision. Again, got to be certain and disciplined to be able to do this. And I'm not saying it's the right thing to do either. I'm saying that it's an option that you could potentially consider depending on the trade you're taking, depending on the type of system you're operating under, all this kind of other stuff. Anyway, guys, we'll be here for you in the channel. And, of course, it's a big archive of stuff to check out. Good trading. Take care. See you next one. Bye-bye.